We all love the potential for passive income from real estate investments. But after a surge in property values, you may be suffering from something called cap rate compression. In this video, we're going to take a quick look at this concept and how it may be impacting your returns. Let's start with the concept of a cap rate, which is simply the net operating income expressed as an annual return percentage. So for example, if a property worth $1 million is generating $50,000 a year in annual income from rents, the cap rate is $50,000 divided by $1 million for 5%. That's simple enough, but what happens over the course of time when this property value goes up to, say, $1.5 million and the annual income has only risen to $57,000 a year? Well, we take $57,000 and divide by $1.5 million and get a cap rate of 3.8%. The good news is that the property value and rents have gone up. But the bad news is that the cap rate has been compressed. In this case, it has dropped by a whopping 24%. If the rents had kept pace with the property appreciation, the passive income would be $75,000 a year. That is an income difference of $18,000 or $1,500 per month. The math is even more dramatic on larger numbers. Imagine a multifamily property that was originally purchased for $5 million, producing $260,000 in annual income for a cap rate of 5.2%. But years later, the value is now $8.5 million and rental income has only risen to $305,000 per year. In that case, the cap rate has been compressed to only 3.6%, a massive drop of 31%. If the cap rate had kept better pace with the market to even 5%, the difference in income would be $120,000 a year or almost $10,000 per month. This is exactly why real estate investors periodically roll up into new investment properties. By taking their gains and finding assets with higher cap rates, they generate potential for more passive income than they would by staying in the same asset. Fortunately, there is great news for investors experiencing cap rate compression. By using an alternative 1031 exchange structure, investors can roll into institutional-grade real estate investments. This not only seeks to mitigate capital gains, but provides certainty of close, diversification, and strives to address cap rate and property appreciation concerns. If you're uncertain about your cap rate or real estate returns, please contact us for a hassle-free analysis and consultation. We will go through the numbers with you and give you an understanding of your options. In the long run, it has the potential to be worth a lot of money.